That brings me to another point. Never ever chase returns in fixed income. That it will almost always end badly. Keep it, that's your rock solid. Just like our government has the National Savings Scheme Fund, you think of your portfolio as the foundation. I mean, the fixed income part as the foundation of your portfolio. The equity part can oscillate and give you the wealth driver or beat inflation, but the fixed income should be your rock solid support.
That's definitely a mind shift and something to think about. For me, for sure, right? I'm always looking for stuff that will beat inflation. Otherwise, is it a worthwhile investment? But no, it is what guarantees, that smooth curve towards retirement. So yes, this needs a little bit of settling into the entire thought process. Welcome back to this two-parter on the entire world of debt. And this week particularly, our year-ending episode all about debt mutual funds and how powerful and useful they are in our goals towards investing and retirement. But to welcome back, we left last week's episode on a tantalizing note. We are becoming experts at teasing the audience into more information and watching us again. But yes, how do debt mutual funds work to start off this episode?
So let's discuss this with a simple example. Let's think about FDs, right? So there are 3 FDs. One is a 1-year FD, a 5-year FD, and a 10-year FD. Now,
sure.
In the normal situation, what we will do is we'll open the FD. After 1 year, we'll close it, and then we'll open it again. Or after 5 years, we'll close it, and so on. Now, what if I can sell the FD to another person in between or mid tenure? That's the whole idea based on which the bond market works, right? If everybody held on to their bonds and never sold it midterm, that is before the bond ends, to another person, the world of debt would be trivial. But let's imagine what happens if you can sell it midterm. It's not practical because people like to make money. Because wherever money can be made, people like to be made. So like to make it. So yeah. So now let's imagine what happens. So I have this 1-year FD, and I just opened it today, and I have opened it, let's say, at 5% return.
Yeah.
And I am going to try and sell it to you, and more or less right away. So what would you think? So if you are going to buy an FD from me, what this means is after you buy, you will get the interest for the remaining period on a prorated basis.
Yes.
Right. So if you buy it after 2 months, for the next 10 months, you will get a prorated interest. So that part of it is fine. That is not there's no loss.
And I can calculate that math easily.
Yeah, that is not an issue there. Now the question is, at what price would you buy it? Let's say I opened the FD at 1,000 rupees. Would you still give me the 1,000 rupees, or would you give me more or less? Now, what would you look at? You say, why should I buy the 1-year FD from me? I can go to the bank and start an 1-year FD myself.
Exactly.
But it could so happen that when you start an FD, the 1-year FD returns have dropped to, let's say, 4%.
Oh.
So when you open it yourself, you get 4%. But when you buy it from me, you get 5%. Therefore, you will be willing to pay more than 1,000 rupees to get it from me. And I can charge, that means I can charge a premium. You can reverse the argument, and say, now if the current FD rates are 6%, you would say, why should I buy it from you?
Exactly.
But you would buy it from me if I sell at less than 1,000.
Yeah.
So I have to sell at a loss, and you would get that premium. So now so the moment I decide my nice, simple, innocuous 1-year FD, I decide to sell it and put it out in the market, the price will start fluctuating on a daily basis, depending on demand and supply.
Got it.
And therefore, a debt mutual fund is basically something that holds predominantly bonds, just like an equity fund holds predominantly stocks. An equity mutual fund holds predominantly stocks. And just like an equity mutual fund's NAV is based on the current market price, the debt mutual fund's NAV is also based on the current market price of all the bonds it holds. and this can fluctuate. Now, imagine what would happen in the case of the 5-year FD. If you are going to, the same idea will apply in terms of higher than 1,000 rupees or lower than 1,000 rupees premium or a loss. However, the risk is higher because let us say you decided to, so my FD is 5%. If you open the FD is 4%, so you decide to buy from me. But 2 weeks after you bought it from me, the FD rates shot up to 6%. Oh, that will be, oh no, what did I do? I made a mistake. But that mistake is not going to be a serious mistake because you have bought only a 1-year bond and that is like for the next 10 months or so it's a very short term. But imagine the same situation over a 5-year case and a 10-year case. Over a 10-year case, you can expect the volatility to be higher because you expect the returns to change or the situation to change, the economic situation of the country can change. So which means that the premiums will also increase or the losses will also increase because it's going to be a bigger mistake. So if you buy the 5-year FD after 2 months from me and after you purchase it, the current FD rates increase, you have to hold on to that for the next remainder for several few years, right? So that the risk is higher. And therefore, the volatility of the 5-year bond will be higher because of this underlying risk than the 1-year bond. Am I making sense?
Beautiful. I it's very rare you get that feeling, wow, I learned something new. So thank you for that. Keep going, Pattu.
Similarly, the 10-year FD will have a higher volatility than the 5-year FD because it's a much more bigger risk buying midterm. So that is the first thing that we need to understand about the debt mutual fund. One, it is marked to market. That is the value of the bonds is marked to the current market price. And a debt fund holding long duration bonds will fluctuate much more than a debt fund holding short duration bonds. So longer the duration, more the volatility in the NAV. That is the first thumb rule.
And chances of higher earnings as well, right?
That depends. Or you have to wait for for a longer time to pan out. I mean, in the short term it's luck, but longer time it's a better idea. So you can look at this via a metric called the average maturity of a portfolio. There is a metric in a debt fund. There are several metrics. We are going to talk about only the simple metrics. This is called the average maturity. So this is the weighted average of the durations of the bond, each of the bonds, depending on how much they have in the portfolio. That will be the weighted average. So higher the average maturity, most often higher the NAV volatility. So if you take a liquid fund, the average maturity will be like 4 months, 5 months, 3 months, something like that. So it's much less than a year. If you take a gilt fund, the fund holding predominantly government bonds, it can range from 5 years, 6 years, 10 years, even more. So you can expect the gilt fund to be oscillating much more in NAV than a liquid fund. So that's the first idea. The second point is that the market does not wait for the interest rates to actually change. There's a lot of speculation, just like there is speculation in the equity market.
Yeah.
People are going to worry what's going to happen in the next quarter, next 3 months. There will also there's a lot of speculation in the debt market. People will not wait for the interest rates to change. They will expect the interest rates to increase or decrease in the next 2 months, 3 months, RBI to change repo rate, etc. So there's a lot of speculation, and that speculation will drive the demand and supply and therefore the price. So people will not wait for the interest rates to change.
Got it.
And this speculation has become higher and higher and higher in the Indian bond market. So because of the players, the number of players that has increased. The foreign investors are there, the Indian domestic investors are there, the retail investors have also come in. Of course, it is not as dramatic as in the equity segment, but it's healthier, I would say.
Which raises a quick question, Pattu. How does a retail investor like you and me trade in bonds? We can't, right? Or can we?
We can. In the past few years, we can. It is possible. There are some portals which allow this bond trading. It's not as frequent, or as free as I would say than equity fund. That's why I keep telling people, you don't really need an equity mutual fund. You can open a demat account in 2 days. Third day, you can start selling and buying any stock you want. Whereas you cannot do that in the debt segment.
Yeah.
Many of the bonds are not reachable. Many of the bonds you can't access. The retail investors can't access. So some they can, but not all. A debt fund is such a beautiful product that it gives you a bouquet of bonds which ordinarily is accessible only by the corporate guy and not the corporate investor, and not by the retail investor. So it's a much more, it's a beautiful product, but it has got its problems. So that's the idea about the average maturity. So this is called as interest rate risk or duration risk. Longer the duration, higher the volatility.
Got it.
That's the first idea. The second idea is with respect to credit score rating. How trustworthy is the borrower? So for this, there is a rating called sovereign, which is to represent the government borrowings. That you cannot rate the credit worthiness of a government when you are a resident. When you are a resident national, you can't do it. Whereas a foreign investor can give ratings on the Indian government. You can see that this agency has changed the government rating from this to that.
Downgraded, upgraded, all of that.
That is relevant only for the foreigner, not for the Indian. For the resident Indian or even for the NRI, the government money is sovereign. It's that's the ultimate guarantee that there is. So that cannot be rated, but other corporates can be rated. There are several kinds of rating scales. For example, long-term bonds, you have the AAA rating. Then you have the AA. Just like you have gradings in school, A, B, A plus, and so on. Short-term bonds have a different scale called A1, A2, etc. and so on. Are they reliable? These rating agencies, are they reliable or not? Many people would know, if you have seen the movie Big Short, you would know that they are not. They also have their own conflicts of interests to worry about. They have to be in business, otherwise the company will choose somebody else to rate them. And also they can be arbitrary. Suddenly your rating can change from AA to default D, just like that. And so you can't prepare yourself for any kind of change like that. So the way the market works is, higher the credit rating, lower is the interest rate.
Fair enough.
Which is the counterintuitive idea that a guy who is financially weak is expected to pay more interest because the person who is investing is taking a higher risk, and therefore that higher risk must be met with a adequate premium. That is the notion of risk premium. So there are bonds which invest in only risky, there are debt funds which invest only in risky bonds, which are called credit risk funds. Then there is a mixture. There is always some kitschy kind of thing in everywhere we go. So the next thing we should look at is the average credit rating of the portfolio. If you look at a category like liquid funds, or if you look at something called a money market fund, a money market is usually a name given to the short segment of the bond market, that is trading happening over a day, over a couple of days and so on, where money itself is the commodity. The money itself is, they say, you hold on to my money for a day and give me a little bit extra. That's how the money market works. So these are there's something called a money market fund which invests in very short term bonds over a few months, maybe up to a year or so. Most of the funds in this category invest in high rated bonds. Most of the funds in the liquid fund category, where the bonds can only be about 90 days, not more than 90 days, they also invest in high rated bonds. So you can look at the average credit rating and decide which is good for you. So there are two things to look at in a debt fund. One is the average maturity of the portfolio. Higher the average maturity, more it's going to fluctuate. So higher the average maturity, it should be used for longer and longer durations. my thumb rule is take a liquid fund. It has got a average maturity about 90 days, approximately 4 months maximum, which means you should invest it for durations 1 year and above safely.
Yeah.
So if your fund has an average maturity of 5 years, use it for 10 years. That's the kind of thumb rule that I have. Many people give you wrong advice. If the average maturity is 5 years, you invest for 5 years. That is completely wrong, because the fund manager will keep changing. At any point, the average maturity will always be 5 years or approximately close to it. So longer the average maturity, longer your investment duration. And stay away from risky debt. If otherwise, I mean, if you have a large portfolio and you can afford to take risk, you can do it. But if you have very little money to play with, stay away from risky debt, which means your average rating should either be sovereign or it should be AAA, something close to that. So those are the simple thumb rules over which your debt funds operate.
Amazing. Opening up a genuinely new world to me, Pattu. There's something incongruous in my mind, right? You've kind of made it apparent that there's so much trading going on a daily basis in the bond market. Yet we categorize these as fixed income. But it's not really fixed, right?
No. It's anything but fixed. Debt funds are not replacements for fixed deposits. The returns from debt funds can be just about anything. They're not guaranteed at all. It is just a traditional name that it comes from the idea of a bond. Just like you have a name of you call it a gilt. The government bond is called a gilt because the old paper. You've seen these diaries.
Edges, yeah.
Exactly. So that's how the government bond was distinguished from other bonds. So we still use these archaic names.
Okay. Now the entire process, which I guess everyone's waiting for, is how do we figure out which one is for me as an individual investor?
So
what is the process?
So the first thing to appreciate is that, like what I just said, they are not fixed deposit replacements. Sometimes the return can be higher than FDs, sometimes not, whatever. Your aim is to be is that of a portfolio manager, like I explained in the last episode. Why we need debt funds, and we need the liquidity, and automatically, because you're only withdrawing partial amount and paying tax on the partial amount, it is going to be more tax beneficial than a fixed deposit. With that in mind, I would keep it very, very simple and say, for short-term needs, for few years, 3, 5, 6 years, whatever, stay away from all other debt funds other than liquid funds and money market funds. Because in my experience, most funds, most AMCs in these two categories stick to safe debt. At least after the Franklin episode, they have understood that it's better to be safe. The credit, I'm talking about credit rating here. The duration risk will be low because they are short-term bonds. So they're not going to fluctuate too much. The NAV is not going to fluctuate too much. And the credit rating is also going to be high. So you can stick to liquid funds and money market for short-term needs.
And liquid funds from any of the big 3, 4. I mean, I'm looking at the AUMs, they're massive, right? Some are like 60,000 crore and above, etc.
So yeah, if you choose a high AUM AMC, you know that they're not going to muck around with that kind of funds. They're going to be responsible and stay away from risk. But you should not expect too much. Many people say, last 1 year liquid funds are given 7%, so I'm going to put money there. That is really silly because it will change. The moment you start investing, returns will fall. That's the usual Murphy's law. We should.
I genuinely experience it as well with each investment. But anyway, so short-term goals, liquid funds. It's a nice thumb rule, very easy to remember, Pattu. But what happens to targets beyond 5 years then?
Yeah, so I would say up to 10 years, stick to liquid funds and money market funds. Money market funds are for those who can take a little bit more risk. Of course, there are situations where the money market can be a problem because, for example, during the Corona fall, the stock market fall, liquidity dried up and nobody bought short-term bonds. So the government had to step in and buy. They had to be the buyer to bolster. So during that time, there will be a few months where the NAV goes a little bit and so on. But usually the NAV goes like that.
Upward trend, yeah.
So there are
Smooth
two
curve.
components to, I forgot to mention, there are two components to how a liquid fund offers returns. One is the interest on the underlying bonds. So a little bit of that interest, that is, they're going to calculate how much interest per year and proportionately increase the NAV every day. So that's one component. The other is capital gains. When I sell, like in the case of the 1 year FD, when I sold it to you for a premium, that will get added up to the NAV, or capital losses will get subtracted from the NAV. So capital gains or losses and interest, those are the two components of a debt fund return. So for short-term goals, up to 10 years, I would say liquid fund, money market fund. If you are comfortable with something called arbitrage fund, which is not a debt fund, which is a hybrid fund, equity and bond hybrid, you can choose an arbitrage fund. In fact, many people are now pushing arbitrage fund as a replacement for liquid funds.
I see. For short-term goals also. Something has
anything
popped up in my mind, Pattu. Sorry, I must clear it, right? You said there are two aspects to how the NAV is affected for a liquid fund or any debt mutual fund. For us, in all practical matters, it's just the NAV, right, that goes up. Which leads to a question of then what is the difference in a debt mutual fund of this growth versus IDCW?
No, that is the dividend. The IDCW, we talked about this previously, it's a poor name for a dividend fund which the SEBI is in. So there are funds in which the fund manager will sell a portion of stocks, sell a portion of bonds, convert it into cash and distribute it to the dividend holders. That is the IDCW, the income, the distributable income option.
But how does that work in a liquid fund where they only own? What are the
you can sell the bond, convert it into cash and give it to you.
Fair enough. Okay.
That's cool. It's fairly similar.
All right. And what about super long-term goals for my retirement in say 30 years?
So these require some higher appreciation of risk, because if you want to buy a debt fund, you can't choose a liquid fund or a money market fund for a 15-year goal, because that will be like overkill in terms of being safe, right? You will get very low returns. You can safely use a corporate bond fund or a what's it called, a gilt fund. A corporate bond fund, if I'm not wrong, invests only in bonds that are, most of them will be AAA rated. I think a small section can be AA rated as well, if I'm not wrong. But they're corporate, but they're safe corporates. And that's the corporate bonds which the fund will invest in. That will have slightly lower volatility than a government bond, but the risk is there. The risk of default is there.
Right.
If you are worried about the risk,
is HDFC, ICICI, SBI, the usual ones in the corporate bond segment.
Yeah, those are good options. So, like I said, the corporate bond NAV will be not as volatile as a gilt fund, a fund holding only government bonds, but they will be much more volatile than a liquid fund or a money market fund. And they are also subject to credit defaults. So, but it's a reasonable buy. It's not such a terrible buy. And for those who are scared of credit issues, they can stick to gilt funds. And so those are the 4 categories I will recommend. Just the 4 categories. For short-term goals or even medium-term goals up to 10 years, stick to liquid funds and money market funds. And for long-term, stick to corporate bonds or gilt funds after you appreciate risks, because these can give you poor returns or even negative returns over a year or two.
But is it a fair question to ask that do these corporate bonds, which you are recommending for long-term goals, such as retirement, and have you seen that they at least beat inflation? Because that's literally 50% of our portfolio.
I would say, don't expect your debt instruments to beat inflation. You expect
they're just a safeguard for your money, basically.
Yes. You expect your portfolio to beat inflation. That brings me to another point. Never ever chase returns in fixed income. That it will almost always end badly. So you have to be very, keep it, that's your rock solid, just like our government has the National Savings Scheme Fund. You think of your portfolio as the foundation, the fixed income part as the foundation of your portfolio. And the equity part can oscillate and give you the wealth driver or beat inflation, but the fixed income should be your rock solid support.
That's definitely a mind shift and something to think about for me, for sure, right? I'm always looking for stuff that will beat inflation. Otherwise, is it a worthwhile investment? But no, it is what guarantees, that smooth curve towards retirement. So, yes, this needs a little bit of settling into the entire thought process. Pattu, this has been an amazing episode so far. I have perhaps maybe one or two more final questions. Remember, in a previous episode, I'd said, what if we had to simplify our entire world of planning for retirement and just break it down to one equity mutual fund and one debt mutual fund? What would be that one debt mutual fund?
So, for those who may not have seen the earlier episode, the one equity fund is a simple Nifty or a Sensex index fund.
Exactly.
For the equity part, I would say a corporate bond or a gilt fund is better. There are passive debt fund options in India, but the problem with them is that they will be very volatile. There will be long-term passive 5-year government bond ETFs are there, 10-year government bond ETFs are there. They can be quite volatile, and it is not for most people, because if you hold a long-term gilt fund or a long-term corporate bond, there can be months where the returns are very poor. It can be negative. Even a couple of years can be negative altogether. Because I've been holding my gilt and it has been 5.5, 5%, 6%. It is just now starting to inch towards 6%. But I'm just holding because waiting for the RBI to cut rates. When they cut rates, the interest will go up. And that is something that we haven't talked about. So when the interest rates fall, the bond prices will shoot, because when the interest rates fall, the market will expect the existing bonds to have lower interest rate.
Yeah.
So the current bonds will have higher interest rate and higher value. So hot property, and therefore your NAV will shoot up. So that can happen. So you have to go through those periods, and that can be so for passive options in debt. That can be a frustrating hold. So I would say a gilt fund or corporate bond fund is still that one fund that you can hold.
On that note, Pattu, I think perhaps we bid farewell to our listeners for this year. Pattu and I are perhaps going on a 2-week break for Christmas and New Year. Wishing all of you all a fantastic end of the year. What a year it's been with you, growing our audience slowly. The feedback has been so encouraging. Pattu, any last words on this entire last few months of Let's Get Rich with Pattu, and then what we can look forward to in 2024?
I've had a wonderful time, and it has given me so many ideas to write about, because I'm always looking for ideas to write, and after writing 2000 plus articles, I'm having writer's block because I don't know what new I'm going to say. So I'm getting these ideas from you, from the team, as well as from our listeners who with our comments and questions. So it's very productive process for me. Yesterday I wrote this article. The article about what is it? Explain to me like I'm 5. What is a debt fund? That was my article on this. So I could it gives me another way to think. Hopefully useful thoughts. So with that, I would like to wish you, the team, and our listeners a wonderful New Year and Merry Christmas.
Thank you so much, Pattu. It's been a thoroughly enjoyable 2023. And even from this episode, right, so many questions keep popping to mind about what happened in the Franklin Templeton episode, what happens when we hear stories about how the US may default on its bond payments, etc., etc. There's so much to talk about even on this particular topic. But if you take this entire stretch of 31 episodes that we've done in 2023, listeners, viewers, urging you to write in. And while we absolutely love your comments that, praise us and encourage us and thank us for everything we do, we would love you to also write in with genuine questions that you have. And that's our job. Pattu and I will keep answering them. And we'll see you in 2024. Until then, Merry Christmas, have a fantastic New Year. And see you soon, our entire small family of Let's Get Rich with Pattu. Pattu, thank you so much, and goodbye.
Bye-bye.